Hello, this is Dale. I've been a trader for greater than 4 decades, hedge fund manager, and founder of what I believe is the very best website, educational website for options available today, www.optionsinfinity.com. Today's video, what I'm going to be talking about is why I don't use stops with credit spreads. I've been trading for a long time, and I can remember early on in my trading career, I read a lot of books and was told by a lot of people that whenever you put a trade on, you need to put a stop. And they used to call them stop losses, which is a misnomer, because many times I put a stop on below where the stock was trading, and the stock would come down and touch the point where I had the stop and then revert right back up to where it was. Come to find out later that the market makers actually can see where stops are. And if a lot of people, and I was a young trader then, and you know, I would put it around a round number or something like that. Well, apparently a lot of other people do that. And they could see a large volume of trades just sitting there to be plucked off. After many bad experiences with stops, I have stopped doing stops. But I always have a visual picture of when I want to get out of a trade. So I've got a visual stop in my mind, and I've got that written down, and you know, before trading starts during the day when I'm doing my planning, I have this written down that this is then a visual stop for me. So but I've been teaching with credit spreads a method of reducing the loss, and I thought maybe I can institute a stop loss on that to my benefit. So let me go through here a little bit. This is a graph that shows the price. This happened to be the SPX, and of course there's with the credit spread. In this case, what I'm doing is I'm putting on a bear call. So I sell one out of the money and then buy one further out of the money for protection. Now, once again, with a credit spread, it doesn't always have to go in the direction you want it to go. This was a bear call, so it's a bearish strategy. So you win when the price goes down, you win when it goes sideways, you win when it goes slightly up, but you lose if it crosses your strike. So what I do is when it gets close to the short strike is a good time to exit the trade. So you can decrease the loss amount. If you have a 5-point spread on your credit spread, then you have $500 margin because there's 100 shares per contract. So the 100 times $5 spread is $500 margin. Minus if you have a dollar credit or $100 credit, you're at risk for $400. Well, if I'm going to take in 100 and I'm risking 400, I don't like that too much. So I wanted to get this down to about 150. So now I'm very close to a 1-to-1 risk return ratio, which is incredible, because credit spreads, my trading usually returns about 75 to 80% winning trades. I've been doing this publicly. I've been sending out alerts for the last 10 years. So I got thinking about this and I said, okay, option theory tells us that if we close a credit spread right at the strike price, the loss will be half the spread, or 250. Okay, 4 or 5 point spread. And the reason it is half, if you think about it, when the price gets close to the strike price that you sold, it'll be very close to at the money, and the theta of an at the money option is 0.5. Okay, so 0.5 times the 5 point spread is 2.5. Okay, so $250. Of course, now we have minus the $100 credit, so now we can get $150 risk. So now we've got that 1-to-1 ratio. So I said, okay, well, how can I automate this for a lot of people that are working and they just don't have time to continue to watch it? Well, the beautiful thing about credit spreads is you really don't have to be a chart hawker and watch this all the time, because usually they don't move that much. So, I utilized Thinkorswim, which is my broker. I'm not affiliated with them. I happen to feel they're one of the best. But anyhow, you can set it up so you can put in a stop limit at a price here of the 250. Now, I usually go with a nickel more. So once I execute the trade, then I can put in a stop limit that if it comes down and touches the short strike, I'm going to get out. Okay, so that looks really good to me. All right, so now we're going to talk about reality. This is a bull put credit spread that I placed at 9:45 on Thursday, January 28th, 2021. And you can see that the market had come down hard, came down to the -1 on the regression channel, and then it picked back up at about 9:45. I placed a bull put spread 5 February where I sold the 37.20 and bought the 37.15 for protection. For that, I got a credit of about $1.30. Excellent. Okay. So then during the day, the market went up nicely, and then towards the close, it started giving back some of that profit. But and then the last 30 minutes, we had quite a drop, but still the 5 February selling the 37.20 and buying the 37.15 put credit spread had a debit of $1.05. So we got in here, and right here we had a profit of 25 cents. Okay. Now let me tell you what happened. And this is pretty ugly. And I want to make sure that all my mentees, all the people that follow me on YouTube, are aware of this. I'm a retail investor just like you. And I just got manipulated by the market makers. As was seen, I had a bull put credit spread on for $1.30 credit. I placed the stop limit at 245 debit. The spread closed, like I showed you, at $1.05 for 25 cents profit. Remember, there's 100 shares per contract, so that's $25 per contract. I have a relatively large account, so I had quite a few option contracts. When I checked my account, the stop limit had been triggered at $2.50 debit. or $120 per contract loss. I contacted my broker, who I've been doing business with for 10 plus years. And after them looking at it and talking to a number of people on the trade desk, I was told that sometimes at the end of the session, now remember there was quite a drop towards the end of the session, but the debit that I saw never dropped below, or never, never gave me less than $1.05. They said sometimes towards the end of the session, the bid-ask spread widens. Okay, that makes sense. But when it widens, that gives the market makers a chance to look at the difference there. And I was a victim of that anomaly. All of a sudden, the debit went from $1.05 to $2.50. So I was told that sometimes towards the end of the session, this happens. And my immediate reaction was, no way, no way. Now, I've been trading for greater than 4 decades, like I said, and I know what I'm doing. And this happened to me, okay? I feel I was victimized with no recourse but to accept, oh, well, that's the way the market is. And that's the way the market is. And no wonder people are afraid of market manipulation. I took it one step farther. I called the FINRA, which is the Regulation Board of Trading. In other words, the people, the brokers report to the FINRA, and explained this to them and said, I understand that this is why I got triggered at the stop limit, but this is not the way it should happen. I haven't gotten any response from them as of yet. I want you all to be aware that this can happen. Therefore, what am I going to do in the future? I'm going to continue to abide by the rules that I established way back when, and that is no stops. No stops. They can be manipulated. It's best to know where you would get out of a trade and manage it accordingly with a visual stop. Now, a mentor can help you pointing out these pitfalls in trading. They can give you their knowledge of many years of actual practice. I mean, I have seen so many things. This was a shock to me. I'd never seen this, and that's why I'm passing it along to you. Mentors can help you understand the importance of the psychology of trading. What is the psychology of trading? It basically is, if you were to be a successful trader, you have to completely divorce your ego from your trades and just come up with a positive expectation trading strategy and trade it, knowing that you're going to have losses, you're going to have losing streaks, but knowing in the long run you've got a positive trading strategy, and check your emotions at the door. A mentor can help by you can look over their shoulder as they're trading and learn how they do that. They can teach you the proper trade size for your portfolio to keep you in the game. That's not one of the number one reasons why most small retail investors are knocked out. They put too much on any given trade and they get knocked out quickly. A mentor can help you reduce losing trader traits. I'd like to be that mentor for you. I've been doing this for a long time. I want to show you my return on margin for the last 2 years, 2019, 2020. You can see I've got losers. I've got losing streaks, But in the long run, I've got a positive expectation equity curve. And this is what you can get if you follow a professional. My website is www.optionsinfinity.com. If you go there, this will be the home page. And if you join me, what you get is, the first thing you get is when I make a trade from my own account, I send out a text and email alert telling all my members that, so that you can earn while you learn. Also, once a month we get together and I teach a little tidbit of what's going on in the market. We look at the general market, then it's open for questions for all the mentees that might be struggling with a point. So I'm constantly teaching, I'm constantly helping, and you can watch professional trade and earn while you learn. I hope you've enjoyed this video. I hope you learn something from this video, and I hope you join Options Infinity. Bye-bye now.